Happy holidays. It's Tom at Hudson Valley Tax Experts. This was going to be an update on last minute tax law changes as part of the December 2020 Stimulus Act, Corona Relief Act. But given the uncertainty in the past couple days, that is premature. So I'm going to give you an update on where we stand at this point, and then the rest of the presentation will be what's at stake in the legislation, which may or may not be relevant given on how the next few days play out. So this, as I said, we're uncertain. If you haven't been paying attention to what's going on in the news lately, I can't say that I blame you. But basically, we had a pandemic relief bill that passed Congress on Monday, and it passed with a strong show of support, really big numbers in both houses, and it was expected to get signed fairly shortly and would be basically a holiday miracle. That didn't happen. Instead, on Tuesday, the president voiced some displeasure with the bill as it was written, particularly about the size of the stimulus payments, as well as some other provisions in the legislation as a whole. And the entire bill, 5,600 pages, which is both the overall spending bill for the upcoming year, plus this pandemic relief latched onto it, was flown to the president for him to deal with on Christmas Eve. Since then, there has been no action on it, no indication from the White House on which way he's going to go with this. And the ticking clock here is that Congress wraps up its business for the year January 3rd, and the current session would end. So that's a hard stop that we're looking at. So the ways that this could play out could happen in a number of ways. The president could sign it in the next couple days, in which case everything would come into play and the rest of this presentation will be relevant. Or he might explicitly veto it. If he does that soon, Congress might have time to override it. The numbers by which the bill passed gives us hope that an override for the veto could happen, and then again, then the bill would become law. But if he doesn't take action, in most times of the year, if he doesn't take action and a 10-day period elapses, the bill becomes law automatically. If he instead does a pocket veto, ignores the bill, and we hit the January 3rd deadline where the current session of Congress disbands, essentially, then we have to start over. And whether that happens in January with the new session of Congress immediately taking it up, or whether action is delayed until after the inauguration, is way too early to speculate, but it certainly means a longer delay for anything here taking effect. So what we do know is that with the bill not being signed, there are going to be certain impacts for taxpayers that are unavoidable. First is that the stimulus checks that the bill provides for aren't going to be going out, of course, and because of the hard stop in the law as to when those can get mailed, the longer the delay is before this bill is signed means fewer people will get them up front, as we'll talk about in the next section. The second super negative benefit is that unemployment benefits are going to get interrupted. That's probably unavoidable at this point because the bill that extended benefits through this week, it has basically expired. So the states are already taking steps to turn off the spigots, and even if this bill were signed today, it might take several weeks before states can start paying benefits again. And the additional payment that is authorized in the new bill apparently is not one that can be paid retroactively. So every week that goes by without this being law means unemployment benefits are not going to see that additional payment as part of their check. So what is in the law that, what's in the bill that is not yet law? So everything from this point forward is not going to take effect until it gets signed or passed by veto override, or until a new bill encompassing it gets through the entire process. So if you're not interested in speculation or knowing what you're possibly missing out on, then this is where you would turn off. But what's in the bill, that's what's at stake. First is economic impact payments for most taxpayers. So this is a program similar to the payments that happened earlier in the year. In this round, payments would be $600 per eligible person. So a married couple with one child would potentially see an $1,800 payment. There are a couple changes to how the program works from the previous round. The first is that people have to have a Social Security number in order to receive a payment, but spouses where one spouse does not have a Social Security number would only lose that person's payment, not the entire household payment. And any income eligibility for a upfront payment would be based on 2019 income instead of either 2018 or 2019. The income limitations in the bill are still the same as they were. So if you earn more than $75,000 as a single person, $150,000 as married filing a joint return, then your benefits are going to get reduced somewhat and could be much smaller or even eliminated if your income is high enough. The ticking time bomb here is that the bill explicitly has a January 15th cutoff date for sending advance payments, because presumably the IRS at that point would become busy actually dealing with tax returns. So if payments aren't sent, any payments that aren't sent by January 15th would not happen. Any missing credit, either from this round or additional credits from prior round, would be claimed on the 2020 tax return. So they're not entirely lost, but one benefit of the advanced payments is that they were explicitly designed to go to taxpayers and could not be used to offset back taxes owed to the IRS or to the state, couldn't go to student loan payments that were in arrears, for example. Those protections go away, apparently, if this is claimed as a tax credit. So yes, people could still get them, but anyone that has this type of debt would see those payments going to pay the debt rather than actually going into their household bank account. The second huge piece that is hanging in the balance is unemployment benefits for many, many people. The bill proposes extending benefits through March, and it also extends the PUA benefits, which cover people like independent contractors and gig workers who normally wouldn't qualify for unemployment. Those protections expire this week, as well as the additional $600 benefit that's been paid out to people. The new bill replaces that with a $300 additional benefit. But as I said, unless the bill passes quickly, any week that goes by without that being in place is going to be lost. There's also a new eligibility process being put in place for people claiming PUA benefits. They will have 90 days after the bill becomes law to verify that they're eligible for these. That process doesn't exist yet, and given the types of delays we saw when this crisis started back March and April, that could also delay or interrupt benefits down the road, depending on how those systems end up getting implemented. There are tax law changes in the bill, because what would be a late bill in December without tax law changes? Some of them are useful. Definitely the expansions to the child tax credit and the earned income credit will help some people. So both of these credits are based on an adjusted gross income on the tax return. And the bill says that for 2020, taxpayers will be able to choose either 2019 or 2020 income to determine how much they get for these credits. Since they're income based, one number might be better than the other, and this ensures that they get the bigger benefit. It also provides that unemployment benefits aren't going to reduce the child tax credit. Normally, as your income goes up, you might hit a point where that credit gets reduced or eliminated. The unemployment benefits aren't going to count towards that, so people would still get the full credit, or at least the credit they would have otherwise been entitled to, assuming this bill passes. Minor wrinkle, getting into the less useful additions. So the CARES Act allowed people who don't itemize on their tax returns to claim a $300 deduction on their 2020 return for cash donations. The new bill proposes giving a similar benefit for 2021, expanding it to $600 for married filing a joint return. But although that sounds great, it doesn't translate into a huge amount of tax savings. Anything's better than nothing, of course, but it's not a major factor in the bill. Flexible spending accounts are normally use it or lose it accounts. If you don't use up the money in a healthcare flex account or dependent care flex account by December 31st, any remaining funds are forfeited. And the bill says that for 2020 and for 2021, excess funds could be rolled into the following year. So some people might not have used up all of their dependent care funds because they ended up being home with their kids for homeschooling or whatever, and daycares were closed. This bill would let that money not be lost, assuming, like everything else, that it passes into law. The bill permanently adjusts the threshold for medical expenses. So if you do itemize on your tax return, you can only deduct medical expenses if they exceed a certain threshold of your income. And that last year was 7.5%, and it was scheduled to go up to 10% for 2020. And the new bill reduces it to 7.5% as permanently as anything is when it comes to tax law. So if you have high medical expenses not paid by insurance and otherwise, a benefit from itemizing, this would be helpful in that case. There's a provision that employers who pay their student loan payments can offer that benefit tax-free to their employees through 2025. Right now, I believe it's only for 2020. I think it's only for 1 year. So this would extend that a little bit for employers that want to offer that perk. And they've decided to play with the federal education benefits. So there's 3 tax benefits that are broadly available to people with education expenses for themselves or their children: the American Opportunity Credit, the Lifetime Learning Credit, and the Tuition and Fees Deduction. Each has their own specific requirements, and each is useful in certain circumstances. So in the guise of simplifying the matter, they are eliminating tuition and fees deduction and expanding the lifetime learning credit, which simple is always better, but simple is always sounds better, but it isn't necessarily better in practice. Some people benefit from the tuition and fees deduction that they don't from lifetime learning credit. This would reduce that. This would eliminate that. Sorry about that. This would eliminate that that additional choice as an option. Certain military and federal employees, most military and federal employees, were involuntarily subjected to the payroll tax deferral program. Most private employers opted out of this. So this was a program where in the second half of 2020, employers could decide to not deduct Social Security taxes for their employees for the second half of the year, and then would have to pay those amounts back in the first 4 months of 2021. And by pay that back, I mean they would take that money out of the paycheck. So you'd have lower deductions for 2020 and then higher deductions from your paycheck in 2021. The repayment period is extended in this bill to cover all of 2021, so it means that the recapture out of your paycheck will be smaller out of each check. So this would affect military and federal employees who are going to see larger deductions than normal in their first 4 months of checks if this bill doesn't pass. There are some provisions targeted at businesses as well. One of those, wrong direction. One of those is the Paycheck Protection Plan loans, PPP loans. First of all, there'll be a second round of PPP funding if this bill passes, which would allow businesses that did not get a loan in the first round to apply again. And some people that got loans in the first round who are severely impacted could get a second round of a second loan in this round of funding if they qualify. The bill also simplifies the forgiveness process for loans under $150,000, which for many small businesses would be a benefit to filling out the previous forgiveness application. And the bill clarifies that any expenses paid with loans that are forgiven can still be deducted on the tax return. This was an area of contention between Congress and the Treasury Department, And this bill now explicitly would clear that up, but it has to pass. The bill also extends EIDL grants and certain tax credits for employee retention, all of which would likely benefit businesses that qualify, so this would be a good thing. And moving into the area of less really useful impact, the bill also says that businesses can deduct 100% of any business meals for 2021 and 2022. Presumably it's supposed to be a benefit to restaurants, but the actual impact is going to be tiny. And then there are a bunch of additional provisions in the law that I'm not going to go through, but are some useful things in here that's still at stake if the bill doesn't pass. So that's where we stand right now. And if anything further develops, I will be sure to let you know. But in the meantime, Happy New Year. Here's hoping 2021 is a better one for all of us.